Uh, Thanks. As we've just declared our Q3 FY20 results a while ago, earlier in the day today. And to come straight to the numbers, for the bank standalone, we closed this quarter at a post-tax profit of 1,596 crores, which is roughly about a 23.6% change on a year-to-year basis. Last year third quarter was this year third quarter. Our sorry. Our net interest income during this period has grown 17% on a year-on-year basis, backed on the fact that the loan growth has been at 10.6%. The net interest margins continue to be pretty healthy, and we have a net interest margin in the quarter at 4.69%. Our other income has grown. If I take a year-on-year number, that's about a 37% growth on a year-on-year basis. Continue to have a pretty decent capital adequacy ratio. We end the quarter with 18.2% at total capital adequacy and 17.7% at Tier 1 capital. Our CASA continues to be pretty healthy. We end the period with 53.7% as CASA's ratio. In addition, there is the TD sweep, which is about 7.4% in addition to the 53.7%. If I look at the average current account balances on a YTD basis, that growth has been about 19% on a year-on-year basis, and savings accounts again have grown by 20% on a year-on-year basis. If we take the CASA plus the term deposits, which are less than 5 crores, that now accounts for as much as 87% of our total deposit base. Even if we take the term deposits, which are less than 1 crore, that has grown decently at 20% on a year-on-year basis. Our return on assets at the bank standalone at 2% if I take the whole 9-month annualized. The loan book, as I said, grew at 10.4% on a year-on-year basis. While we've seen good growth on the retail side, on the home loan LAP, as well as on the agri side, the areas which slowed down were the corporate book and the commercial vehicle construction equipment. Both of them had slower growth. While our GNPA number as of 31st of December at 2.46% and the net NPA at 0.89%. The SMA2 number has come down to 274 crores from 431 crores, which was the number just a quarter ago. So some of the SMA2 which were there sitting as of September have somewhat slipped into the NPA category. At the consolidated number, we have a post-tax profit of 2,349 crores, which has been a 27.5% higher than the same quarter last year. In fact, if you take the non-bank entities at a post-tax level, we've seen a 36% growth on a year-on-year basis. Some of the subsidiaries which have contributed other than the bank, Kotak Prime brings in about 187 crores of post-tax profits. The life insurance company gets in 166 crores. The securities company is about 128 crores. The mutual fund getting in about 91 crores. Again, capital very healthy at the group level, 19.4% overall and 19.0% at the Tier 1 level. The insurance company has seen decent growth during this year, while the solvency ratios remain very healthy. The new business premium itself has grown 64% over the same quarter last year. The securities company did cash market share of 9.2%. The investment bank has been involved in a number of deals which did well this quarter. At the group level, our total assets under management, we have grown by about 30% on a year-on-year basis, and we are now at 2,63,000. The mutual fund AUM itself, the domestic mutual fund, has grown over 30%, with the equity side itself growing by over 35% on a year-on-year basis. We've grown our market share again decently there. The relationship value of the assets we manage under Privy, advise under Privy and Wealth is over 3 lakh crores, which is again up decently from 2,60,000 a year ago. At the group level, advances have seen a lower growth than the bank, primarily coming from the fact that auto in the subsidiary and the capital market numbers have been lower than what was there last year. NIM at the group level at 4.66 and GNPA at 2.33 and NNPA at 0.87. Return on assets at the group level, if I again take the 9-month annualized, at 2.22, which continues to be pretty healthy. That's the broad highlights during the quarter. I must add one more thing. In the bank standalone, the profits for this quarter did get impacted by what is a non-recurring item, which is hitting our employee cost, which we've taken a hit of estimated about 200 crores, which is coming from the change of annuity tables. This impacts the pensionable employees, which are part of the union which we inherited from the ING Vaishya merger. So we have about 2,000 live employees and about 3,000 odd retired employees. So they will need to be paid higher, and that's the hit which we have taken the entire amount in this quarter. So that's why you see the employee cost which has gone up this period.
So at the operating profit level, then would it be correct to assume that this is the hit that has
That's
come?
correct.
Yes,
That's
yes,
right.
yes.
The operating profit factors this number.
Okay.
It
And
does.
how many employees you said?
About 2,000 on rolls and about 3,000 retired. The retired employees also get the benefit.
Basically, the pension benefits go to everyone. What happens is we put our deposit with LIC. So LIC has changed the rate from October from about 7.9% to 6.9% because their expectation of future interest rates really. So that has an immediate impact, and we necessarily recognize it always as one time.
And on the loan growth, is this specific hit because of the CVC segment?
No, I think loan growth, you must look at it in the context. First of all, you must broadly divide it into two parts. Yeah, the retail businesses and the wholesale businesses. Yeah, in the wholesale businesses, what has happened is the lendable set of entities has shrunk. The lendable, I'm saying, not the wanting money. Who you can comfortably lend to has shrunk. So the choice really is you lend more to them. How much more do you lend to them? Yeah, that's on the corporate side. On the retail side, it is very good. Like Jaimin said, on the retail side, our growth rates are in the 17-18% really. It's really the corporate side this time which has not really grown. And the corporate side has two subparts, wholesale and SME. SME has been slow, because across segments of SME, the loan requirements have been pretty restricted. So we've not found opportunities to grow, as much as we would want to be there. On the wholesale side, like I said, there are fewer corporates who you can lend to, and those corporates require larger monies. So there is an amount only how much you can lend to them. So you get restricted by that.
On the retail side as well, like 17 to 18%, I mean, you have been growing.
Yeah.
But a couple of other industry players, for example.
Again, retail, what happens is there are two subcomponents, the secured part and the unsecured part. I think the growth rate opportunity on the unsecured part is much higher. On the secured part, largely you have cars and basically home loans really. So you can only grow so much in those two segments. So the growth opportunity on the unsecured side is much higher, but that comes with a different kind of risk. And in some of these, you have to be very clear. It's very easy to lend out today. Yeah. The impact of this you will feel only 2 years later and 3 years later. Yeah. So you have to be very conscious of that when you start lending in each of these segments really.
So loan growth at 10% is a multi-quarter low for Kotak.
Yeah.
Just wanted to get, what is the outlook going forward? What do you expect?
So I think outlook, we will have to wait to see how the economy overall grows. And you see, we must understand at the end of the day, there is a real growth in the economy which has shrunk significantly. And there is a nominal growth which is real growth plus inflation. So inflation was traditionally over the last, if you look at 1-2 years, very low. So overall nominal growth was very low. So from a bank perspective, what you can lend with limited risk is only a multiple of the nominal growth. So in an environment where nominal growth itself was 6-7%, you could only grow so much. But now what we are seeing really is real growth, let's say, still remains in the 5 to 6% range. but inflation is catching up. So let's say if inflation is 4, 5, 6%, the nominal growth then becomes 10, 12%. When nominal growth becomes 10, 12%, then as a bank, you lend a multiple of that. Then it is possible for you to start lending higher, really. But in this environment, like I said, it's a trade-off between how much can I lend at what spread, because the risk of that, see, from a firm point of view, we look at net of risk return, really. So how much can you lend to who? Yeah, and at what spread? When you lend, you make only 2%. Yeah, if you lose money, you lose 100%. So that trade-off you must keep in mind. So I think we are waiting to see that movement, which is widespread, to start growing faster on the non-retail side, really.
So in light of that, have you revised the credit growth outlook for the entire year?
I think it is picking up. Like I said, nominal growth has picked up. So
No, but your
by,
credit growth outlook, have you revised that?
I think it is looking much better now. Yeah,
Do you
it is.
expect it will be
We haven't said a number really, but it's looking much better now. Yeah, mid-teens.
Mid-teens,
Mid-
yeah.
Yeah, but you see, mid-teens you must look at in the context of how much we have grown over now. I think maybe for the year mid-teens may not be possible, but it still will be close to that, really. Yes.
So where is this conservatism coming from on the retail side as well?
No, like I said, retail side is two subparts: secured and unsecured. Secured you can only grow so much because there is so much growth on home loans and car loans, really. Yeah, people are not buying cars and people are not buying as much homes as we traditionally saw. On the unsecured side, really, there are three segments, really. Either it is personal loan, or it is credit cards, or let's say microfinance. There is only so much a risk appetite will allow you to grow there. And we use a lot of analytics to see who we can lend to, how much we can lend to, how long we can lend to, at what rates. The returns are better, but so are the risks. So you want to grow only so much and not more than that, really.
So are you worried a little bit more about the retail loans now kind of getting a little riskier going ahead? And would you want to control that?
I think on the retail side, it is not looking that worrying still, really. Yeah. You see, retail, you will start getting into trouble only when job losses start happening, or you see potential threat of job losses. I don't think we've seen widespread threat of job losses at this stage, so it doesn't look that worrying. But there are segments which may look worrying, like, microfinance, for example. Based on what is happening in some of the states, may look worrying, really. So you have to be guarded in each of these. And back to us, the approach has been, I must move cautiously. Yeah, once you see the road ahead being very clear, then you move fast, really.
What are these lendable sectors?
It's actually less lendable sectors. I think it is more lendable entities. Yeah, so it's not necessarily a sector issue. It is more, okay, it's like your stock market. Yeah, 20 stocks define bulk of the movement. Yeah, so it's so also on the wholesale side. Just a bunch of entities define who you can lend, and they must be wanting money.
Is this the unsecured? Where do you see this
No, unsecured is, my comment was more on the retail side, really.
on the secured front? Where do you think you should be growing your loan?
So growth, you see, like I said, once we see nominal growth rates back to the 10, 12%, then the opportunity from a bank's perspective to look at growing a multiple of that is higher. So let's say if nominal gets back to 10, 12%, one can look at 15, 20% growth rates at that point of time.
So on the wholesale side, is this lendable corporate, so to say, are those being impacted because of the group exposure norms?
Yes, of course, of course, of course. There are two types of norms over there. One is the regulatory norms. B is how much we think we are comfortable in lending,
So going ahead, in terms of your outlook for the road ahead, as you mentioned,
Yeah, yeah,
clarity,
yeah.
what is the clarity? In how long, how far can you see the road ahead?
No, I think just now, from a visibility point of view, see, back again, on the wholesale side, capital expenditure still is very limited. Okay, it's still not really happening big time. Working capital demands still are limited, yeah, because cycles haven't changed, at least for the better performing ones, really, yeah. So there is that limited requirement. Yeah, and this you must necessarily, like I said, look at it in the overall context of lendable. Yeah, it's not that there are no people wanting money. Yeah, you got to look at it from who and how much do you want to lend to.
And why is this caution coming from? I mean, after 1 year, more than 1 year,
It's a very simple equation, like I said. On the upside, you have an upside of 2%. Yeah, the downside is close to 100%, and you will know that downside only 3 years later. You won't realize it today.
So, I mean, and what my question is that after 2 years, you're still seeing the downside as big and as.
Because you're seeing new bullets out there. You look at it progressively over the last 2, 3 years, and there's more to do on the wholesale and the SME side. Every quarter you see new bullets. Yeah, and a lot of these bullets are in the realm of what I call unknown. Yeah, you don't expect that bullet to get shot, but it does. And it's not a sectoral problem. Yeah, it's not the traditional infra, power, telecom, those type of segments. These are newer entities. It's a lot more of entity related bullets which are creating the problems. And these are bulk problems. Suddenly you get a hit of 500 crores, or suddenly a company with leverage of maybe 2,000, 3,000 crores gets into trouble. It is a new type of a problem.
And you think that there can more unknowns that can kind of.
I think going forward, what one has to be worried about really are the unknown unknowns. I think the known unknowns and the known knowns are already out there. Yeah, most of us are aware of them really.
So in
Yeah.
terms of
I think, yeah, sorry.
Considering what you've been saying, you're still confident of maintaining the correct cost guidance at about 60 basis points.
I think in the 60s is still reasonably comfortable, yes.
And LAP and Agri have been growing for you, one at 20%, one at 16.8%, considering what one of the other peer banks had faced on the Agri side. Is there any concern about?
No, Agri again, see there are segments and sub-segments of Agri. In Agri, what is relatively weaker is lending on the crop loan side really. That is troubled. But a lot of other Agri is okay. Yeah. And again, LAP, you see, LAP, basically the LAP part to the SMEs or the segments of the SME which are stretched is trouble. But LAP, where it is working capital, facilitating a business and that business or that sector of that business doing well, is okay. It's not doing badly.
So not all business.
So all,
which are SME,
yes.
which are LAP.
Yeah. It's back again. You see, it is concentrated lendable base. Yeah. And in that concentrated lendable base, how much more can you lend really? So there is only so much more you want to lend when your nominal growth rates are 7-8% really. Remember that.
so according to your presentation, about 1,000 crores net addition to your gross non-performing assets. Can you break down where those come from?
So 1,000 crores, like I said, part of that 1,000 crores is unknowns, yeah, which would account for, I'd say, at least a third of that really. And then, like Jaimin said, SMAs have come down, but there is a good news in that and there is a bad news in that. The good news really is no fresh SMAs really have been created. So the future looks definitely at this point of time significantly better. But some of those SMAs have obviously moved to the NPAs.
What are these unknowns that you now see?
They are not, they were unknown unknowns, but they are now reasonably known knowns.
Sectors are we talking about?
Like I said, it's not a sectoral problem. This is individual entity problems, really. I mean, you don't conclude that the sector was a problem because of which. But these are entities. They are, they are all the known names. So, if you want to prompt some sectors, then I can tell you yes or no, really.
Perhaps it could prompt some names. So is it all sectors? I think that's.
Well, the names are all, like I said, known ones now. They were unknown, maybe.
That Altico, DHFL. Everybody knows it.
So, some of them, yes and no, really. Yeah.
So going ahead, if you.
So, that's what I'm saying. The worry is now shifted to these unknown bullets, which just come and hit at this point of time. So it's not a broad.
Because these are anyway coming from the so-called notorious or
Not necessarily, not necessarily. Yeah, real estate, yes, I can understand. Yeah, but not necessarily some of the other ones.
Leveraged companies are also one.
It's not only a leverage problem. Some of them 3 months back were double A rated entities with no leverage, and suddenly you realize that there's a huge leverage and the rating has changed. So that's what you got to be worried about. And you see, back again, like I said, it's a pretty adverse equation. Yeah, your upside is only that much, 2%, and your downside, if it goes wrong, is so you got to be right in 49 out of 50 cases.
What is the reason you're being so? I mean, what are these unknown unknowns? I mean, why is it becoming unknown suddenly?
Because they come out of the blue. Yeah.
That I understand, but why?
Why?
Suddenly, what's going wrong?
So, well, if you take some of those names, there may be governance-related issues, there may be accounting-related issues, there may be something which has suddenly gone wrong, which has created that issue. Yeah, it may be regulatory issue, it may be judicial issue, it may be.
Couldn't be the banks read it wrong?
See, if the banks read it, it never is like that. Normally at the time of entry, it is easy to read what is out there at that point of time. Yeah, the problem happens really is as you progress, and then there is a cost of exit, and exit is not necessarily very easy in some of these cases. So you're really, out there holding the baby. That's when it gets into trouble.
In terms of the NBFC crisis, I mean, do you see that that's taking out, and is there any kind of further bullets that can be fired from there?
Well, the NBFC piece, bulk of it was, I'd say, related to, the real estate segment per se. Yeah, either in terms of the actual retail piece or in the form of the corporate wholesale piece. So that's one segment where a lot of it now is in the known category rather than the known unknown category. But you still have issues on the NBFC side. For example, if some of these microfinance issues go out of control because of social and political reasons, that could be a red flag. If we start looking at job losses going forward, some of the unsecured pieces on the retail lendings could start looking spotty, really.
Would you want to increase your book on
So it's back again. So how much can you increase more? So the only way you can increase is not look at every Tom, Dick, and Harry NBFC. So you try and limit your exposure to the half dozen well-performing ones. And the issue back again, like I said on the wholesale side, is there are those good-performing half a dozen, 10 entities. And there is only so much you can, increase your exposures to them from an overall risk management point of view. And that's what is really the constraint.
what about the existing book? How are you protecting the bank from any surprises on the?
Well, we hoped we did a good decision when we entered and when we reviewed it.
Are you strengthening provisioning or increasing that?
No, so if you look at Jermyn's statements, the provisioning coverage is pretty comfortable. Yeah, at 64-ish.
64%.
We are pretty comfortable at this point of time, really. So, and we've been taking aggressive provisioning calls.
No, but you mentioned 3 months ago, the account was, assuming whichever account that is, was AA rated, and suddenly it threw up a surprise. So is there some sort of change in risk monitoring you're looking at, or internal?
But you see, that falls in the unknown category, so it becomes difficult. But generally, you see, if you look at us, we've been very conservative both on the acquisition side as well as the accounting and the provisioning side, really.
So much of the NPA this quarter has come from the corporate accounts.
No, not necessarily alone, really. Yeah. Like the unknowns might have accounted for about a third of them, but otherwise it's broad-based, yes.
Retail, like the commercial.
Yep.
So how many are
In general, in the marketplace or ours?
out of the 1/3 that you one-third?
Just one or two of them, really. That's why it is unknown. If it was widespread, we would have been widely known, really.
During the quarter, has there been any change in your general outlook on loans? Like when you're mentioning about unsecured being sort of cautious,
you're also mentioning about the unknown unknowns repeatedly. So has there been any sort of change in your sort of approach itself?
I think
to
that's a
lending?
continuous process,
Or-
as industries
and what
change.
has it been?
No, let's say some industries may come under pressure for various reasons. So you will review that. Some industries, the pressure might ease, particularly on the commodity side. If you see, some of the pressures have eased, yeah, for various reasons. So you take a far more progressive view on those sectors. You tighten on sectors where you think it is more of a problem now.
Which are those where you
No, for example, power or let's say alternate energy users. These are large capex guzzlers, yeah. But there are problems which are out there, and some of these are long-term exposures. So you got to start worrying about them for various reasons. Yes.
and so what is worrying on the unsecured sides? Because you're saying that the job losses.
See,
sector is not
unsecured,
playing
the
out yet.
base
Still you're
issue
cautious.
ultimately on the unsecured is when you're doing your lending, how much of it is genuine requirement, how much of it is consumption requirement, and how much of it is going for running the Ponzi. Yeah, it is rotating the lending. Yeah, and then the one which always creates a problem is the last category. Yeah, because when credit cycles tighten, yeah, the Ponzi or the rotation ones, yeah, those are the customers which really suffer. And then the velocity of deterioration is very, very fast, really.
So till now there was a lot of proliferation of such Ponzi. Sort of
No, it's not that. It's not lot of, even if it is a small percentage. Yeah, you cannot afford too much of it, really. And normally what happens is circulation happens if availability or supply of financing is reasonable. But let's say when NBFCs per se generally get into trouble, then supply is not very easy. Or, once you get into trouble, your civil scores will start reflecting that trouble. So it's not easy for you to get money easily from anyone then, really. So then then it dries up. So some of those reasons, really.
So what is the bank's exposure to the telecom sector, and would the AGR, payment impact any accounts that you would have exposure to?
Well, in what way? We have some exposure to telecom, yes, of course.
There are bank guarantees with a lot of banks have given, and if the DOT decides to, all those bank guarantees, and it would become.
No, I don't think the problem is the existing guarantees. The problem really is how will these companies meet their requirements going forward, which is fresh cash requirement, really. So on the existing one, I don't think there is an issue, no. Yeah, so those don't get into trouble. It's really future what they have to pay up for the AGR, which is how they fund it, really. No, I think our approach has been conservative on telecom. Yeah.
And also, what about renewing those wages? Are you willing to?
So we've been pretty selective on that. Yeah, that's a simple credit call.
Can you give us an amount, how much?
No, we haven't disclosed that, really. Yeah, but it's very limited. Yes, we do have an exposure. Yes, yes, yes. I mean, there are not too many others. It is only.
Just one question, slightly broad question. Are we seeing a situation where also a lot of better rated corporates, larger corporates are also tightening their purse strings? They're cutting off spend that they would have earlier done, and you're seeing them also deleveraging.
Not really, not really. Actually, it is, but it's a select few now which is really growing. Yeah, either investing. They are borrowing, of course, they are borrowing. But you see, the problem really is how much more do you lend? Yeah, at the end of the day, each one of us has our own concentration limits, really. And what happens in our case is, in addition to the regulatory concentration limits, what we found actually work over the last 20 years very well is absolute concentration limits. Yeah, because it's very difficult for you to say when things will go wrong. When things go wrong, you don't want a large problem on your hand one fine day morning, really. Yeah, so you necessarily need to, in addition to regulatory limits, also look at absolute concentration limits, really. But in general, I think if we were to compare between, let's say, the previous 1 or 2 quarters and today, it looks far more positive today than it did about 2 quarters back, really.
Have you participated for
we have a lot of stress business ourselves, so there is nothing specific that we should really be looking at there. No, I don't think we've evaluated it at this stage, really. But we participate in stress across, various segments. Phoenix is just the ARC piece. We have a large stress asset fund, really, which is doing very well, and the bank itself. Yes, we've just closed one of them. Yes. No, we haven't disclosed it.
Just wanted to circle back to the NBFC. So what is the opinion going ahead? Do you think that this is going to get contained, or do you see something more spilling over to the banking sector?
See, in the case of the NBFC, there are two sets of issues. Yeah, one is issue related to liquidity, and the second is issues related to solvency. Yeah, the liquidity issue gets controlled if there is adequate supply available of lendable money. Yeah. So earlier, yes, a lot of that was coming from, let's say, the mutual fund system. As that gets replaced by the banking system, it eases up liquidity. Solvency can only be solved by fresh equity.
So yeah, that's
So you tell me how that fresh equity will come.
But would you, as a banker, want to lend to some of the increase the exposure to this sector?
No, so like I said, it's back to the corporate issue. There are only so many ones where you want to lend more to or where you can lend more to. And that's what you do.
You wouldn't want to kind of take any additional, go down the ladder of the rating.
Not really, yes. See, the equation becomes back again very adverse. Yep. From the lendable piece, the moment you expand, your spread is not moving disproportionate to the risk. At the end of the day, what is relevant is risk-adjusted return, really.
So, what is your corporate to retail ratio?
About less than 40% would be corporate. It's about 80 on 216 is what we've closed this time with. So about 80, 83 would be corporate. The balance would be what is traditionally retail. Internally, we split retail into consumer and commercial, but otherwise that's retail. That's part of the 83.
Sir, you have mentioned that restarted Aadhaar-based 811 account.
Yeah.
So all new 811 accounts are Aadhaar-based only, or?
Yeah, it's primarily Aadhaar-based because that's the authentication process, really. And then the good thing really is some of that now can go the video KYC, and that's going to be a phenomenal one, actually. Yeah, once we put it in place, it will really be again, a path-breaking one. Really.
What do you expect to hear in the budget of the banking sector?
Let's wait. I don't want to take any.
The tough ones he has to answer.
I think let's do this over chai break and chai. Thank you, friends, very much.
Just one
Yeah.
clarification. You're expecting a mid-teens, you said, credit growth, right?
Yeah.
It's like 15%.
Mid-teens is you start at 13 and you end at 19. So mid.
So tell us
It's not the median. See, it's very difficult to, again, please don't misunderstand me. All I'm saying is the opportunity basket going forward looks better now. Okay? It's not the same as it was in the past. But that opportunity basket is still limited to a few players.
Is it better or better?
Better. But it's still limited to a few players. And then there it really depends on how much return you get for the delta risk which you are willing to take, really. So, but it looks better. So I think one should expect an improvement. And again, like I said, the nominal growth rates are moving up. Yeah, that in itself is an opportunity for a financial services firm.
Thank
Yep.
you, Deepak. Thank you, Jamie.
Thank you.
Let's have
Thank
chai
you.
with this.
Yep.
Just as we were speaking, DOT has raised a 48,000 crore India charge for oil and gas.
Very
It's only 2 times the net worth of oil.
That's